Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Living in fear of the rally every day. 2026.5.5. This video presents a direct informational narration of the source document. So let's jump right into a market environment that literally has investors living in fear of the rally every single day. We are going to break down exactly what is driving this incredibly wild market. Today, we are unpacking 4 massive topics. First, we'll look at macro forces and geopolitics. Second, we dive into the AI earnings surge. Third, we'll explore the hardware versus software divide. And finally, we will wrap up with the crypto pivot and tech valuations. All right, kicking things off with Section 1, macro forces and geopolitics. The major U.S. indices collectively closed higher, with both the S&P and NASDAQ hitting fresh new highs. This is happening despite recent attacks on merchant ships and the UAE. What's absolutely fascinating is how officials across the board are deliberately downplaying the situation. Defense Secretary Hegseth held a press conference stating the U.S. military's Operation Sentinel in the Strait of Hormuz is purely defensive in nature, just a temporary mission and not seeking engagement. The Iranian Joint Commander denied recent attacks on the UAE, and Iranian Foreign Minister Araghchi even stated that negotiations with the U.S. are making progress. International oil prices retreated after a huge surge. Because neither side actually wants to escalate and both are talking down the incident, the market firmly believes this war is trending toward de-escalation. But behind the scenes, according to institutional monitoring, after that recent exchange of fire, the Iranian Revolutionary Guard Corps expanded its control over the Strait of Hormuz. Ships were forced to gather in waters further away, reportedly relocating near Dubai. Today, the Strait of Hormuz is almost entirely empty of ships. It's calm because there are literally no ships there. Iraq's oil cannot be shipped out, so driven by necessity, they came up with a massive incentive, offering May contract buyers a discount of up to $33.40 per barrel. But there is a massive catch. If the buyer accepts the terms, pays, and losses occur en route due to the war, Iraq will not provide any refunds. Moving on to Section 2, the AI earnings surge. We have a really interesting contrast happening in the macro data right now. The 30-year U.S. Treasury yield is hovering right around that critical 5% mark. At the same time, the April ISM Services PMI retreated from 54 to 53.6, missing the market expectation of 53.7. Couple that with high price pressures, and you've got stagflation fears flaring up. This makes it incredibly difficult for new Fed Chair Walsh's rate cut plan to advance. However, U.S. Treasury yields actually retreated after the data release, showing the U.S. Treasury is actively stepping in to keep the yield from breaking above 5%. To put that global pressure into perspective, over in the UK, the 30-year government bond yield has just shot up to its highest level since 1998. Despite the continuous climb in U.S. Treasury yields, the stalemate in the Middle East, and continuously narrowing market breadth, there is one massive reason investors remain incredibly optimistic, and it comes down to this figure, 28%. Data from the London Stock Exchange Group indicates that, driven entirely by the AI investment boom, S&P 500 companies are expected to see a 28% year-over-year profit growth in the first quarter. That is more than double the expected value at the start of the earnings season in early April. A strong earnings season continues to bring optimism, helping the S&P 500 index recover almost all of last Friday's losses, with the prospect of challenging the 7,300-point integer mark. The NASDAQ 100 trend is even stronger, having broken through 28,000 points. The technology sector is just in a state of unilateral frenzy. Wall Street analysts state that the fundamentals of the U.S. stock market are very solid, and, coupled with expectations of geopolitical de-escalation, this should allow bulls to maintain the advantage. But pay close attention to their phrasing. They didn't say the market won't fall. They strategically said that declines can be viewed as buying opportunities, meaning they cannot be wrong whether the market rises or falls. Let's look at some individual players. AMD released its earnings report after the bell, posting $10.25 billion in Q1 revenue with a net profit of $1.38 billion and an adjusted EPS of $1.37, all exceeding expectations. Q2 revenue is projected to be around $11.2 billion, fluctuating by $300 million up or down, higher than the expected $10.52 billion. This guidance implies a massive 50.6% year-over-year revenue growth and a 9.1% quarter-over-quarter growth, with gross margins expected to remain around 56%.
Optical communications leader Light also delivered post-market fireworks. Fiscal Q3 revenue was $800 million, up 90% year-over-year, with an adjusted EPS of 2.37. They expect fiscal Q4 revenue of $960 million to $1.01 billion and an adjusted EPS of 2.85 to 3.05, also above expectations. But here's the crazy part. Despite stellar numbers, both stock prices initially dived in after-hours trading before finally pulling back up. The true trend will completely depend on tomorrow's intraday trading.
That brings us right into Section 3, the hardware versus software divide. Intel's stock just surged 13%, and there's a huge story behind it. Bloomberg reported that Apple is considering partnering with Intel and Samsung to produce processors for its devices, right after Tim Cook mentioned supply shortages. For over a decade, Apple has insisted on designing its own chips and outsourcing manufacturing strictly to TSMC, with the latest iPhones and Macs already utilizing the 3-nanometer process. However, with the frantic expansion of AI data centers and the higher-than-expected demand for Macs capable of running local AI models, TSMC's capacity has become significantly strained. They simply have too many orders to handle. Under these circumstances, Apple has been forced to consider seeking secondary supply sources. Apple executives have already conducted on-site inspections of Samsung's new factory in Texas. Now, current engagements with Intel and Samsung remain in the early stages, without actual orders formed, and Apple has always maintained reservations about non-TSMC manufacturing processes, so it's uncertain if they will ultimately bring in new partners. But for Intel, securing Apple orders would be a critical breakthrough for Lip-Bu Tan's revival of the foundry business. For Samsung, despite its foundry capabilities lagging behind TSMC, entering the Apple supply chain would be a massive positive. This hardware frenzy is continuing to pull massive capital into storage concept stocks. MU's market capitalization has completely surpassed $700 billion. Market sentiment is highly enthusiastic, already starting to imagine a path toward the trillion-dollar club. And then we have this jaw-dropping figure, $42 billion. Meanwhile, SNDK is aggressively accelerating the lock-in of future revenue. The company has signed 5 long-term supply agreements, expected to cover more than 1/3 of its NAND shipments for fiscal year 2027. Management even stated this proportion could increase to over 50%. The 3 contracts signed in the third quarter alone have a minimum contract value reaching approximately $42 billion. And these aren't just handshakes. These contracts include collateral and default compensation mechanisms, making them significantly more binding than traditional agreements. Simultaneously, the HV production line advanced by the company will launch within the year, with the complete system solution expected to land in the first half of 2027. The overall pacing is very clear. It is currently very obvious in the US stock market that capital is entirely being absorbed by storage and Intel. Conversely, AI application software is struggling. Popular software stocks like Shopify and Palantir all fell after releasing their earnings reports. Shopify's stock price plummeted over 15.6% today. The company's first quarter revenue was $3.17 billion, a 34% year-over-year increase that beat expectations. Gross merchandise volume reached $100.7 billion, growing 34.8% year-over-year. Profitability and cash flow are solid, with $5.7 billion in cash and absolutely no debt. Even though the company expects second quarter growth to slow to 25 to 30%, which was basically in line with market expectations, the stock was still completely dumped. Palantir faced a similar situation. First quarter revenue growth hit a post-IPO high, net profit nearly quadrupled, full-year guidance was raised, and the U.S. business saw explosive growth. But because commercial revenues slightly missed expectations, the market seized on this as a flaw, causing the stock to drop nearly 7%. The current market narrative is somewhat extreme, seemingly believing that in the AI era, the long-term value of traditional software will be completely overturned. However, a more reasonable understanding is that software hasn't lost its value, it's undergoing a generational upgrade. Old models will be reconstructed, and new AI-driven software is taking over the stage. In the short term, it's a matter of capital preference blindly chasing hardware. In the long term, the ultimate winners will be those companies that can translate AI into actual products and revenue. Yet, right now, the market is currently selling indiscriminately. Moving on to our final section, crypto pivot and tech valuations. Cryptocurrency concept stocks maintained their strength, clearly ignited by the dual narrative of Bitcoin and AI. Take CIFR, for example. Their first quarter revenue fell to $34.8 million, a sharp quarter-over-quarter drop of 41.7% that completely missed market expectations. However, losses improved, with a net loss narrowing from $734 million in the previous quarter to $114 million, primarily driven by book value repairs from reduced non-cash expenses and fair value adjustments.
But the market basically doesn't care about the revenue drop. Why? Because the company is accelerating its transition from the Bitcoin mining business to AI data centers. This has become the exact story that capital is more willing to support right now. The market has chosen to temporarily ignore currently unattractive performance to focus strictly on the future, such as the company's approximately $11.4 billion in contract revenue, underlying lease terms of 10 to 15 years, and a massive plan to expand computing power scale to 4.2 gigawatts by 2030. At the same time, liquidity remains abundant. By the end of the first quarter, it held approximately $4.2 billion in cash and equivalents. Total assets also grew from $4.3 billion at the end of last year to $6.4 billion today, primarily driven by data center projects under construction. Overall, although there is short-term earnings pressure, the market views the path to future revenue growth as having strong visibility as these data centers gradually come online.
In contrast, PayPal's earnings somewhat disappointed investors. Although first quarter revenue reached $8.35 billion, a 7% year-over-year increase, and earnings per share of 1.34 both exceeded expectations, core user data was weak. Active accounts grew by only 1%, and the volume of transactions per account declined, reflecting ongoing competitive pressure. Guidance was cautious, projecting second quarter earnings per share to decrease by about 9% year-over-year, indicating management prefers to stabilize first. They are advancing layoffs and cost optimization, but in the short term, the market is clearly unwilling to pay for this slow recovery. Meta's stock price has continued to face pressure recently, and its valuation has been compressed to relatively low levels. Its current forward price-to-earnings ratio is only 18 times, near a 3-year low, distinctly lower than other large tech companies, and its valuation gap with Google has widened to the highest level since 2022. The issue doesn't lie with the business itself. Meta's advertising revenue maintains good growth. However, investors are deeply divided over Zuckerberg's aggressive AI investments. This year, the company plans to invest up to $135 billion in capital expenditures, while long-term debt has rapidly climbed from about $10 billion to over $50–70 billion. Without the support of a cloud business, the upside AI brings to the advertising business is viewed as having a ceiling, and Meta has no obvious leading advantage in the large AI model competition. These factors make market sentiment waver. The stock market behaves exactly this way. When it rises, reasons can always be found to remain bullish, and when it falls, a pile of problems can always be highlighted. Social media platform Pinterest delivered decent first quarter results. Revenue was $1 billion, an 18% year-over-year increase, and adjusted EPS was 0.27. Global monthly active users grew 11% year-over-year to 631 million, setting a historical high. The company's cash flow is quite healthy, with net operating cash flow of $328 million and free cash flow of $312 million, showing strong inherent business capability. However, after the stock gapped up over 17% early in the session, it hit overhead gap resistance and retreated, closing with a narrowed gain of 6.81%. On Semiconductors, Q1 revenue grew 5% year-over-year, with the AI data center business growing over 30% sequentially. Adjusted EPS was 0.64, both beating expectations. The company expects Q2 revenue between $1.54 billion and $1.64 billion, and adjusted EPS between 0.65 and 0.77, with midpoints beating expectations. The stock saw a volatile long and short tug-of-war intraday, closing slightly up. Financial data services company Fiserv saw its stock absolutely plunge after earnings. Q1 revenue was $4.68 billion, down 2% year-over-year, and adjusted EPS was 1.79, down 16%, though slightly better than market expectations. The data shows the company is in a transition pain period, burning cash for transition while new businesses are not yet profitable. It maintained its 2026 EPS guidance of $8 to $8.30, making the May 14th Investor Day absolutely critical to answer when current investments will yield returns. Individual stock risk remains highly elevated, making a long-term hold of QQQ a safer choice for peace of mind. Additionally, other tech stocks like MSTR, AOALB, SMCI, and Arista released earnings post-market, showing mixed movements, which will be detailed tomorrow. As the source observes, the so-called value investing model can literally be disrupted in an instant right now. So it leaves us with the ultimate question. With traditional models constantly disrupted by the AI shift, how can investors navigate this extreme divergence between soaring hardware infrastructure and lagging software applications?